Have you ever had that feeling? You sit down with a financial advisor, you pour out all your hopes and dreams for the future, and what you get back is a plan that just feels, well, kind of generic, like it could have been for literally anyone? Yeah, you are not alone. Today, we're going to pull back the curtain on why so much of that standard financial advice just falls flat for most people. And more importantly, we're going to look at a completely different way to think about building your wealth. Right. Let's start here, because this quote just hits the nail on the head. It's what's called boilerplate investing. You go in, they ask you a few questions, your age, your income, maybe some vague question about your risk tolerance. And boom, out comes this prepackaged one-size-fits-all portfolio. It's the financial version of a copy-paste email. There's no real strategy tailored to you, no real education, just a handshake and a good luck. It leaves you feeling like you have zero control. And the craziest part about this boilerplate approach is the corner it backs you into. Because when that generic plan doesn't quite line up with the life you actually want to live, you're usually given one option. Choice A, you have to shrink your goals. That dream house, retiring early, traveling the world? Sorry, they say. That's just not realistic. You're going to have to work longer, live a little cheaper. But there is another way. There's choice B. You can expand your education, find a better strategy that actually fits your goals, and stop trying to cram your dreams into their flawed, tiny box. So that's exactly what we're going to do today. We're going to map out that second path, choice B. First, we'll break down the boilerplate investing trap. Then, we'll get into the most critical mindset shift of all, understanding net worth versus cash flow. After that, we'll build a whole new system using something called the 4-pillar framework. We'll dive deep into what it means to invest for cash flow and what real risk management looks like. And finally, we'll see how you can go from just hoping for the best to actively building the future you want. Okay, first up, let's really get our hands dirty and deconstruct this whole problem, the boilerplate investing trap. It's something millions of people are stuck in, and a lot of them don't even know there's another way. The fundamental flaw, the thing that makes this whole system so shaky, is its obsession with one single number, net worth. The entire game plan is to just shovel money into a 401k, buy a big basket of mutual funds, and then you just wait. You hope that over 30 or 40 years, that number goes up. This hope and wait strategy is a recipe for anxiety, because your entire retirement, your whole future, is tied to a number that can get chopped in half by a market crash you have absolutely no control over. I mean, how can you possibly plan your life around that kind of uncertainty? And that leads us right to the most important idea we're going to talk about today. Seriously, this is the aha moment. This is the concept that, once you get it, changes absolutely everything. It's the huge difference between net worth and cash flow. Just take a look at this. It lays it all out perfectly. On the left, you've got net worth. It looks like a heart attack-inducing roller coaster, right? Up one year, way down the next. It's totally unpredictable. But now, look at the right side. That's cash flow. It's a steady, reliable, upward climbing line. This is the money that actually shows up in your bank account every month. It pays the mortgage, it buys the groceries, it funds your life. The real goal isn't to ride the roller coaster. It's to build that steady, dependable stream of income. So, how do we do that? Well, it starts with redefining what an asset even is. And Robert Kiyosaki has this brilliantly simple rule. An asset is not just something you own, it's something that actively puts money in your pocket. And a liability, that's anything that takes money out of your pocket. Now, this forces you to ask a really tough question. That house you live in, the one that traditional advice calls your biggest asset, is it really, or is it a liability that costs you money every single month? This quote right here, it just cuts through all the noise, doesn't it? It's the whole philosophy in one sentence. You could have a net worth of millions of dollars on paper, but if you have zero cash flow, you can't pay your bills, you can't buy food, you definitely can't retire. Financial freedom isn't about some big, fluctuating number on your 401k statement. It's about having enough cash flow coming in from your assets every single month to cover all your expenses. That's it. That's the game. Okay, so if our real goal is building reliable, steady cash flow instead of just chasing a volatile net worth number, then we need a totally new system. We need a new playbook. And that's where the 4-pillar framework comes into play. It's a completely different way to look at the world of investing. And this table right here illustrates the core idea so perfectly. Just look at the two columns, the things you have zero control over and the things you have total control over. We can't control fundamental analysis, that's trying to figure out a company's true value, and we definitely can't control technical analysis. That's trying to predict which way the market's going to swing based on charts. Honestly, both are just sophisticated guessing games. But what can we control? we can absolutely 100% control our cash flow strategy and our risk management. You see how this just flips the whole script? You stop trying to be a fortune teller, a market psychic trying to guess the future. That's a game you can't win. Instead, you become an engineer. You focus all your energy on the two pillars you can actually control, your cash flow and your risk management, and you build a system, a machine designed to produce income and protect itself no matter what the crazy, unpredictable market decides to do. All right, so let's really zoom in on that first pillar you can control, building cash flow. This is where we learn to stop thinking like an amateur speculator and start acting like a professional investor. So what's the first thing we're taught about money? Fear debt, right? Get out of debt, stay out of debt. But the wealthiest people don't avoid debt. They use it like a powerful tool. The secret is knowing the difference between bad debt and good debt. Bad debt is what most of us are familiar with. Credit cards, car loans. It's borrowing money to buy liabilities, things that go down in value and suck money out of your wallet. But good debt? That's borrowing money to buy an asset that generates more cash flow than the debt payment itself. So how does this actually work in the real world? Let me just walk you through it. Step 1, you find an asset that produces cash flow. Let's use a rental property that brings in $2,000 a month. Step 2, you buy it using mostly the bank's money. That's the good debt. Step 3, the rent you collect, that $2,000, is used to pay the mortgage, which let's say is $1,500. Step 4, that extra $500 left over, that's pure profit that goes straight into your pocket every single month. And step 5, since you might have put very little of your own money into the deal, your return on investment can be massive, even infinite. This is how the wealthy build their asset columns so quickly. This is such a critical distinction to understand. The amateur investor buys a stock and just hopes and prays that the price will go up so they can sell it for a profit, a capital gain. The professional, on the other hand, acquires an asset that pays them to own it. Think about it this way. A professional is like a landlord collecting rent month after month. The amateur is like a house flipper, just hoping to sell for more than they paid. Professionals build systems that generate income consistently. And that brings us to what is, in my opinion, the most critical pillar of them all. This is the one that really separates the pros from the amateurs: risk management. And I'm not just talking about that buzzword you hear all the time, diversification. I mean, from the moment we start learning about investing, it's beaten into our heads, right? Diversification is the golden rule. It's the ultimate safety net. Just spread your money around and you'll be fine. But is that actually true? Is it the magical cure-all that we're told it is? This analogy is just perfect. Diversification is like a flu shot. It's a good thing to have, but it only protects you from one specific type of risk. A flu shot is not going to do anything to protect you from a broken leg or a heart attack. In the same way, diversification only protects you from one type of financial risk, and it leaves you totally exposed to other, much bigger dangers. Let's break it down. Diversification is great for something called non-systemic risk. That's the risk that something bad happens to just one company. The CEO has a scandal, a new product is a total flop. If you own 100 different stocks, one of them blowing up won't ruin you. But it offers zero, and I mean zero, protection against systemic risk. That's the risk that the entire market, the whole system, goes down. Remember 2008? It didn't matter if you were diversified in stocks, bonds, real estate. Everything went down together. So what's the answer? The answer is control. True risk management isn't just about spreading your bets. It's about having control, specifically control over your exit. A professional investor knows exactly how they will get out of an investment before they ever put a single dollar in. It's like this. The story of the Titanic is only a tragedy because there weren't enough lifeboats. If you knew before you boarded that there was no exit plan, you would never get on that ship. So why on earth would you do that with your money? Okay, so let's bring this all home. This is where all the different pieces of the puzzle click into place. We're talking about a fundamental shift in how you see your financial life, from being a passive observer to being in the driver's seat. This quote just perfectly captures the feeling of the average investor, doesn't it? They're completely out of control. They're just passengers on a ride, just praying, just hoping that somehow in 30 years it all works out. We are moving away from that powerless feeling. We're stepping into the role of an architect, actively designing a financial machine that is built to work for us, a machine that has systems to generate income and protect itself. And really, that's the ultimate question it all boils down to. It's the choice between hoping and building. The conventional financial path has you crossing your fingers, just hoping that a flawed plan somehow gets you across the finish line. This other path, the path of financial education, is about taking control, focusing on the things you can actually influence, your cash flow strategy, your risk management, and building a system that is engineered to succeed. The choice is yours to make.